Good morning, everybody. Hey, welcome to the first day of August 2019. I want to thank you for joining us here for the morning show with Dave and Phil, and look forward to our discussion with Dave today after a kind of upsetting day on the markets yesterday. Before we get started, though, I do want to remind you again about our free report on understanding retirement strategies that are out there that we may want to take advantage of as we head into retirement. It gets more and more important that we have the right strategies in place if we're 5 to 10 years out from retirement or we've already retired. Retirement, we really don't get any do-overs in retirement, so we want to get it right the first time. So I've got this free report for you. Text the word retirement to 863-285-3815 here on Facebook. Look at the link above this video, and you can click there, take you right there. Thanks, I appreciate it. Dave will be with us in just a moment.
On 05.7 Light FM. It's 78 degrees here. The sun's out. It's going to get hot today, and it's going to rain. That's enough? Sounds like yesterday's weather forecast. It's not. It's today's. Let's double check on your finances and see what the heck is going on Wall Street with your IRA and your 401k. It was, let's just say interesting yesterday. Phillip Statler is down in his office at Statler Financial Services in downtown Sebring. Phillip, we got our 0.25% interest rate cut out of the Federal Reserve yesterday. I saw that and I figured, market's going to skyrocket. Instead, the Dow turned down and we lost 330 points. What the Sam Hill went on anyway?
Well, we've been talking about interest rates and what the Fed's going to do and what was expected. And most people, I think, expected the 0.25% decline in interest rates. And so people got what they wanted, but yet the market still tanked right afterwards. So,
it did.
Yeah. So we look at it and say, okay, it's not so much what they did, it's what they said. And there's some indication that you and I have talked about how all the analysts were expecting basically a quarter now, maybe a half, but more rate cuts down the line.
Mm-hmm.
That's what the problem was, is that basically Powell came out and said, look, this is not an indication of our forward thinking. We feel like maybe we raised interest rates too fast last year, and so we're giving back one of those rate hikes. But this is no indication whatsoever of future rate cuts going forward. And so that was a big deal.
And somebody on Wall Street said, oh, crud, and pushed the sell button, I gather.
A lot of sell buttons. Buttons.
We were talking yesterday morning that we were expecting people to parse Powell's statement down to the syllable. Doesn't sound to me like it took a lot of parsing. Basically, he said, don't think about 0.75 of a point this year. Don't even think for sure about 0.5 point. Be happy with what you got. Now shut up and go home.
I would say that's a pretty good way of putting it, Dave. That he basically is not only not promising another rate cut, but that he's almost gone the other direction and said there's not one even on the table now to even pop up. So don't even think about another rate cut the rest of this year.
Which, if he changes his mind, will be a pleasant surprise the next time they do it, which is kind of the other side of that coin. I did notice that they mentioned the vote on the open market committee. There, all but 2 of the votes were to drop the rates by 0.25%. 2 votes were against even doing that, and there was no saber rattling, unless we see it in the minutes. There was no saber rattling for a larger cut. So Powell's got. He doesn't exactly have rate hawks on his board, but he certainly doesn't have a passel of doves there either.
No, he doesn't. And so, and I got to think that that's probably a good thing. I mean, but let me just go on a different tangent here for just a minute, because we haven't used the R word for a while, the recession word. And I was reading an article about transportation. Dave, and this one really kind of concerns me, because basically the article is saying that the transportation industry, the trucking industry, is in a recession. That we have actually lost 7 trucking companies this year, transportation companies this year already.
Wow. I didn't know that it had been that kind of a casualty rate. That's amazing.
I didn't either. So I was reading it, and one of them was a very large, employed like 400 or 500 people, just closed up earlier this year. The one that really caught the eye of this article was one out west that still, it was probably 50 employees that they just abruptly closed. And so that gives me some cause for some concern when we see trucking companies start closing up like that.
And generally, it is one sector that triggers an economy-wide recession. It might just be a sector recession, we don't know, but generally one sector falling, and a part of the transportation industry is not a sector you want to see fall because that does tend to take others with it, but that does tend to indicate one more data point in our analysis that, yeah, we're overdue for something resembling a recession, which is kind of why you and I are, I know, of one mind that really precipitous rate cuts right now kind of empties out the toolbox the Fed has for when we do have that inevitable downturn.
No, that's true. What's going to happen when we actually do have an indication that we're in a total, countrywide, industry-wide recession? What are they going to do?
Absolutely. And if we'd done a half a point now, or we promised 3/4 of a point in the statement after the Open Market Committee meeting yesterday, we'd be starting to talk about negative interest rates like they've got in Germany before too long if we weren't careful, because we didn't really have a lot more farther we can go.
Well, that's true. You're right. We don't.
So anyway, setting the table for this morning, that was the really big story for yesterday. I mean, the Dow down 333 3/4 points. NASDAQ was down by almost 100, and the Standard & Poor's was off darn near 33. Everything down by well over 1%. We start the morning out with the weekly jobless claims. They were at 215,000, up 8,000 from last week. Still abnormally low. I got to assume that's probably not going to change anything this morning all that much. Was it a surprise, though?
I don't know that I would call it a surprise, Dave. It was a little more than most people anticipated. Depending upon whose number you looked at, they were looking at 213 to 214. Came in at 215. Like I said, that's you basically say it's in line.
Not basically on targets. I did notice the JOLTS report was showing layoffs still abnormally low, which kind of ameliorates even a disappointment there. Earnings season continues. We got a few household brands, including one you mentioned that kind of was a miss that we're seeing all over TV. I gather Wayfair did not have a good quarter, huh?
Well, it's not they didn't have a good quarter, Dave. They lost $1.35 a share, which amazingly is what the street expected them to do. And they beat on earnings, on revenue too. But here's what caught my eye is that their operating expenses have increased by 50%.
Ooh.
That's a pretty big number to try to overcome. They're trading down 5.6% this morning after what looks like a decent report. And so I think they've got to do some cost control measures to kind of rebound back up.
I was going to say, having reported to the CEO of a publicly traded company once, they're more concerned about expenses out of control than troubles with revenue as a rule.
Well, exactly, because they feel like they can control cost. It's a little harder to control revenue.
Absolutely. Other reports.
So let's look at another big miss. Let's get the bad guys out of the way first. We had Fitbit report. They lost 14 cents a share, which was actually 4 cents less than what Wall Street expected. Revenue did beat the estimates out there, but Fitbit has cut their full year guidance. They're having disappointing sales on their new VersaLite smartwatch, not performing as expected, and so they're probably the big loser today. They're down 18% this morning.
Ouch! That's precipitous.
It'll be a new 52-week low for them. The stock is not an expensive stock anyway. It's right now it would open at $3.44 a share.
Good Lord, they're heading toward penny stock range. Did they say why they were disappointing? Are they losing to Apple? Where operating, or what are they losing to? Or just
really, just as that smartwatch just has not caught on. It doesn't say why. I honestly haven't seen an ad for it. I don't know about you, but usually I'll see stuff about Fitbit, but I've not seen anything about their new smartwatch.
Okay, I knew their little bands sold quite well, but I knew they were trying to market a smartwatch per se, and it looked a little spendy, but it isn't exactly in the price range of an Apple Watch, so I thought it might be a viable option.
Well, yeah, and there's so many different things out there that look like an Apple Watch now that
Hmm.
I think it's becoming a crowded space.
That's true. Couple of other reports we got time for, and I know there's a few other words that we're going to recognize out there in brands.
So we have Verizon.
Hmm.
They came in 3 cents ahead of estimates. Revenue came in a little below what was forecasted. They did add another 245,000 phone subscribers during the quarter. That was significantly better than what everybody had kind of looked for. And so they're trading up about 0.75% this morning. You know, we talked a little bit about Qualcomm last week or so because of Apple buying somebody. I can't remember who it was now.
They
But
bought Intel
there
smartphone
you go.
chip
There
manufacturing,
you
yeah.
go. And so Qualcomm was 5 cents above estimates. Their revenue was good, but I'm sure that they're not so good on the stock side. They're trading down about 6.5% this morning.
Ouch. I know they were getting hit by that kerfuffle we've got with China over that big cell phone manufacturer there because there's a blockade to selling our junk to them.
Well, that's true. I forgot about that. And we had you like this one. You tried to make this one come about yesterday, and that's Dunkin' Donuts.
Yes.
Um, Dunkin' Donuts came in, and they came in 4 cents ahead of estimates. Their revenue was a little short, but their same store sales were a little better than expected. They came in at 1.7%. So the donut side's doing well. The Baskin Robbins side is what's hurting their bottom line right now, and so they're basically unchanged this morning at the open.
As long as you can sell donuts, the economy is just fine, Philip. Got time for one more household word. Pick one.
So how about we look at well, Clorox? You know, that's definitely a household name. Yeah,
Hmm.
they beat by 5 cents a share. Revenue did miss forecast though, and they gave weaker than expected guidance for the 2020 year. They're having some issues with a couple of their product lines, though, and so they're trading down about 4.3% this morning.
All righty. Resetting the table for this morning. It was just a crummy day yesterday, starting about 2 p.m. on Wall Street. Everything was a pretty deep shade of red. 45 minutes before the market opens this morning, Philip, are we changing shades even a little?
I'm going to say we're basically flat this morning. We have given way since the jobs reports come out. We've given way. The futures were looking a little better than what they are right now. The Dow's basically $13, basically flat. The S&P 500 is flat right now. The Nasdaq's up 6.25, pretty flat. Gold and silver are taking a bath right now. We got gold down 1.5% to $1,416 an ounce. We've got silver down 2.3% to $16.02 an ounce right now. And then crude oil is down another 1.8% to $57.51 a barrel.
Yeah, from a consumer standpoint, crude oil can take a bath for a couple of days, can't it?
Exactly. We don't mind seeing that one go down.
Not in the least. Mixed markets overseas. Asia mixed, so was Europe halfway through their day today. Philip, somebody need help to figure out what the impact of all of this is on Wall Street for somebody's retirement. How do I get a hold of you on the phone?
Dave, hey, to schedule their free financial x-ray analysis of the current portfolio, give us a call at 382-0037. To schedule our free report, all you have to do is text the word retirement to 863-285-3815, and then join us every weekend for the Statler Financial Radio Show. I got to get this down a little differently now, Dave. It's 6 and noon on Saturday and 10 a.m. Sunday mornings.
3 times a weekend because it's important. And then, of course, back here tomorrow morning on Light. Fair enough?
Sounds good, buddy. Have a great day, and I'll talk to you in the morning.
Thank you, my friend. It's 105.7 Light FM and Statler Financial Services, Phillip Statler.
Who will be?
Folks, again, I want to thank you for joining us today and remind you of our free report that we have and on retirement strategies. Don't want you to miss out on that. All you have to do is text the word retirement to 863-285-3815, or on Facebook, hey, look at the post right above this. You can click the link. It'll take you right there. Have a great day. I look forward to speaking to you again tomorrow.